Welcome to The Explainer. I am so thrilled you're joining us today because we're going to tackle a problem that is incredibly common across almost every single industry, yet, nobody really likes to talk about it. It's essentially the silent killer of scaling businesses. Today, we're bringing you an actionable survival guide for acquiring that expensive, essential equipment your business desperately needs to grow without completely draining your bank account and going broke in the process. It's honestly the ultimate business paradox, right? An empty wallet despite a booming business. It is just an incredibly frustrating and baffling dilemma for any founder. You look at your accounting software and you see fantastic sales. Your profit margins look absolutely incredible on the books. But then, Thursday rolls around, you need to make payroll or cover immediate financial commitments, and absolute panic sets in because the actual cash just isn't there in the bank. We see this exact trap ensnaring successful, hardworking small and medium-sized enterprises all across the globe. All right, Section 1, the profitability paradox. Let's unravel this mystery and understand exactly why sales on paper just do not always translate to actual money in the bank. Okay, let's dive right into this absolutely crucial distinction. Profitability is your financial performance over time. It basically shows that your fundamental business model is viable and healthy. But cash flow, that's the real-time, day-to-day movement of money in and out of your accounts. Now, the real danger lies in the gap between the two. Think about how the B2B world actually operates. You might land a massive, highly profitable contract today, and you deliver the product tomorrow. But because extended payment terms of 30 to 90 days are pretty much the standard across most industries, you're just left waiting. That dangerous waiting period, where you're funding operations without any incoming revenue, is exactly where scaling companies run out of working capital. Moving on to Section 2, the equipment cash trap. Now that we've got a handle on that cash gap, let's look at the single biggest drain on a growing company's working capital. That massive drain is acquiring expensive, essential equipment. Take the medical and healthcare industry as a prime example of this pressure. Clinics and hospitals need highly specialized, incredibly expensive devices right now just to expand their services or replace failing units. We're talking about $500,000 MRI machines or incredibly advanced surgical robotics. If a clinic decides to just pay for these essential tools with a lump sum cash purchase, well, that massive outlay instantly vaporizes their safety net. It completely devastates their cash reserves, and it leaves the facility incredibly vulnerable to any sudden operational hiccups or delayed insurance payouts. So the crucial point here is understanding how businesses legally and operationally categorize their money. Hospitals, clinics, and really any mid to large business typically separate their funds into two distinct buckets. First, you have the capital budget. That's reserved for major equipment, real estate, and construction. Second, you have the operating budget, which keeps the lights on. It pays for daily things like salaries, rentals, and disposable supplies. And here is the real kicker. Due to strict accounting rules, financial governance, and board approvals, these two buckets are completely locked. Money usually cannot just switch over from one budget to cover a shortfall in the other. Which brings us to a massive, potentially business-ending roadblock. If you literally need a vital piece of equipment to generate revenue, but your capital budget is completely exhausted and the board or your accountants say you absolutely cannot touch your operating budget, what on earth do you do? Section 3, leasing versus buying. This is where we introduce the real hero of our story for preserving that immediate cash flow and navigating those super rigid budgets. Listen to this heavy-hitting statistic. 85% of U.S. companies lease their equipment. And you know what's even more telling? 89% of those companies say they would absolutely do it again. They make this strategic choice because leasing normally costs far less upfront than paying cash. But beyond just saving cash, it shields them from getting stuck with obsolete technology. I mean, in modern business, tech moves so fast that buying a server rack or a medical laser outright basically means you own a depreciating dinosaur in 3 years. Leasing fundamentally changes how the equipment hits your budget while keeping your tech totally cutting edge. This brilliantly illustrates how companies bypass an empty capital budget using a bit of accounting magic. A capital lease is essentially a rent-to-own structure. Because the intent is ownership, it still has to be paid from that strict capital budget. But an operating lease? That's completely different. It's a pay-for-use structure. Because you are only paying for the temporary use of the equipment for a set period of time, accountants classify it as a daily operational expense. This allows you to just slip the expense right past an empty capital budget because the funding actually comes out of your operating budget instead. By mapping your financing solutions to your actual budget realities, you unlock a massive strategic advantage. Utilizing an operating lease means a business keeps those huge equipment costs completely off the balance sheet. It legally and strategically shifts the financial burden, successfully bypassing that empty capital budget we talked about earlier, and ultimately frees up your vital working capital so you can spend it on things like growth, marketing, and payroll. So how do you practically choose between the two? Well, you can use this quick decision matrix. First, look at utilization certainty. Are you going to use this equipment consistently for a decade, or are you just testing out a new service line to see if there's actual demand? Next, weigh your cash flow priority. Is owning the asset free and clear more important to you than preserving your capital today? Third, evaluate technology change. Does this equipment have a stable 20-year life cycle, or is it going to require frequent software and hardware upgrades? Finally, consider the service risk. Do you really want to manage all the maintenance yourself, or do you prefer predictable vendor support? If you need flexibility, capital preservation, and easy upgrades, leasing is almost always the far smarter operational strategy. Section 4, Startup Financing Secrets. Now, what if you don't even have a budget or a matrix to worry about yet? Let's pivot to the specific nightmare facing brand new startups. If you're a startup, you need equipment to generate your very first dollar of revenue, right? But traditional lenders demand 2 to 3 years of revenue history before they'll even glance at your loan application. Well, here is your magic number to break that cycle: a personal credit score of 700 or higher. This is the absolute crucial threshold that unlocks zero-down startup equipment financing. Institutional lenders use this specific score because without a corporate history, they need to feel comfortable taking a risk on the founder's personal character and financial responsibility. We call this the proxy shift. Because a brand new startup has zero business history to underwrite, specialized lenders evaluate proxy indicators instead. They are going to meticulously look at your personal credit score, again, aiming for that 700 plus ideal, though 680 is usually the absolute bare minimum. They'll look at your personal income and net worth outside of the business. Crucially, they'll evaluate your documented industry experience to make sure you actually know how to use the equipment. And finally, they look really closely at the collateral value of the brand name equipment itself, knowing they can just resell it if things go south. Let's ground this in a real-world scenario. Imagine a seasoned dentist who is just finishing their residency. They likely have massive student debt and absolutely zero business history, but they possess a highly bankable degree. Or think of a construction superintendent with 15 years of hard-earned field experience who is finally starting their own excavation company. Specialized lenders will look directly at their professional licenses, their deep domain expertise, and the really strong secondary market value of dental chairs or Caterpillar excavators. Based on that proxy data, they'll approve them for zero-down equipment financing on day one. Section 5, Cash Flow Survival Strategies. Now let's escalate this to some advanced tactics that combine smart financing with incredible tax advantages to truly supercharge your business growth. Okay, let's dive into Section 179. Now, this isn't some shady accounting loophole. It's actually a brilliant, intentional U.S. tax code provision designed by the government to stimulate the economy. It allows businesses to deduct the full purchase price of qualifying new or used equipment right away. When you combine this powerful deduction with smart equipment financing, it's kind of like Uncle Sam is effectively buying your equipment for you. Let's walk through this incredible math hack slowly because it is huge. Imagine you decide to finance $50,000 in equipment to grow your business. By applying the Section 179 deduction, you secure approximately $17,500 in real tax savings at the end of the year. Now, let's say your monthly finance payment for that equipment is $1,120. If you divide your tax savings by your monthly payment, those real money tax savings effectively cover your first 15 and a half months of payments. Think about that for a second. That is essentially free, revenue-generating equipment for well over a year. So, to summarize our survival guide today, here are the 4 non-negotiable steps you absolutely must take to future-proof your business. First, implement weekly cash flow forecasting so you're proactively managing gaps, not just reacting to them in a total panic. Second, establish your business credit early on to separate your personal liability from your company's growth. Third, strategically match your monthly equipment payments to the actual revenue that the equipment generates for you. And step 4, always leverage powerful tools like Section 179 and alternative financing to fiercely protect your working capital. I'm going to leave you with this provocative thought to chew on today. Take a hard, honest look at your current operations. Is your equipment actively driving your throughput and scaling your revenue? Or did paying cash for it completely drain the vital reserves you desperately need to survive those inevitable 90-day B2B invoice delays? It might just be time to rethink your relationship with business finance, protect your daily cash flow, and set your business up to truly thrive. Thanks so much for joining me on this explainer, and keep learning.